Hi, this is Optimus Futures, and we're back with our weekly roundup of key futures markets for our viewers. For this week, we'll be analyzing the markets as they closed on the 1st of June 2018. We had a lot of notable moves across the five markets that we analyze every week. Starting off, of course, with the S&P 500 E-mini futures market, which was an interesting market to follow last week. If you recall our analysis for this market from the prior week, we had obviously talked about how the market had broken out of this wedge pattern formation here towards the upside, and we had talked about how, despite the breakout, the bulls really had not been able to gain any kind of momentum towards the upside that you would typically expect of a powerful breakout towards the upside out of a major and obvious chart pattern like the one we have over here. Instead, we saw the market sort of get trapped at the 2700 level and this former minor swing high over here. We did see a couple of candlesticks sort of close above the 2700 level, but we really didn't see any kind of momentum being built up by the bulls over here, which indicated to us, and we analyzed and mentioned this in our prior week's video, that this market probably looked primed to pull back and at least test the breakout area for the textbook breakout pullback continuation play, or at least a pullback to the 2700 level, and just basically a period of consolidation to allow for the buyers to sort of gain momentum here and allow the market to basically look for higher price levels. And that's exactly what we saw last week after a dead period of trading sessions in the week prior to the last one. We, in the last week, saw the market sort of pull back down underneath the 2700 level, and we see a sharp spike back up. On Friday, actually, the market closed very strongly. We would have actually preferred the market to sort of close above all of the prior bar highs over here that marked the period of brief consolidation that the market had been in. But this is still not a bad outlook at all for buyers for this market. Just looking at the fact that the market has, or apparently seems to have, bounced off the 2700 level, we expect the buyers to be able to gain the momentum that they need to allow the market to see higher price levels. We're looking forward to the market possibly testing the 2800 level that's sitting right around here. Of course, we've had some major swing highs off the 2800 level as well, and that's really our next target for this market if the buyers are really able to gain the momentum that we anticipate and expect of this market. Okay, so the next market we're going to be looking at here is the light crude oil futures market, which was another very interesting market to follow last week. Of course, we've had a market here that's bounced very strongly off the 7200 level. In the past, we had indicated that we were expecting this strong move up to possibly take the market up to 75 price level, and probably price levels close to 75 before we would anticipate a sharp sell-off like we already are now seeing. Unfortunately, that really didn't happen at all. The market did bounce off the 7200 level, and if you zoom out the chart to see why the market did what it did at the 7200 level, it makes a lot of sense and is understandable for an informed technical trader. So as we zoom out of the chart, you can see that the 7200 level basically lines up with an important horizontal support and resistance level for this market. We've had several indications in the past where price roughly held as either support or resistance at this price level, and so no surprise to see the market sort of reacting and resisting at the 7200 level. Although we were more in search of the market possibly pulling all the way up to these more important longer term swing lows that we've had for this market at the 7500 levels, and price levels close to 7500. The market, however, rebounded off the 7200 level, as we see over here. And if we zoom back into the more recent price action, we can see that the selling here has been extremely strong. In our past week's analysis for this market, we had talked about the importance of the 6600 level as a possible support area and a possible obstacle for sellers along the way. Of course, it's been an important level for this market. Over the recent past, we had two indications of very strong resistance at this level, and the market broke past this level, pulled back, held a support right around here, before the market continued up. And you can see last week we did find indications of support at this level. The market temporarily bounced off this level, although eventually on Thursday and Friday the market was able to regain the bearish momentum, and we did see a very strong close underneath the 6600 level, and pretty much at this horizontal support and resistance level drawn by the horizontal green arrow that you see over here. All of this really points to the fact that the bearish activity here does appear to be very strong. We're of course also looking at this rising support trend line. We've had already 3 touches to the trend line which validate it, and of course it now falls in confluence with the 6600 level, right where the market closed on Friday. So you can see that this is a very interesting location now for the market, and the first few trading sessions this week will be extremely interesting. It'll be interesting to see if the market can rebound for a second time in more recent times off the 6600 level, or we'll see the sellers eventually get to push underneath the 6600 authoritatively, break past this support trend line, and just continue on with the bearish momentum, possibly after a quick pullback to the 6600 level, using it as resistance like back over here, and just making a sharp move down back again. Okay, so next we're going to be looking at the gold commodity futures market, which, unlike some of the other markets that we're going to be discussing in this video, really didn't move much at all the past week. Part of the reason for that is that this market obviously is straddled at 1300 major round number, running right around here. Of course, the 1300 level has been acting as a pivot or the oscillating point for much of the consolidation that this market has seen over the past year or so. And of course, there's this more recent consolidation phase just above the 1300 level that price seems to be now stuck at. So basically, we did see a breakout underneath the 1300 level in this former consolidation box over here a couple of weeks ago, but really we didn't see any kind of momentum building up from the sellers here at all, and the market sort of rebounded right back above the 1300 level. But now that it has bounced back above the 1300 level, it's not a true fake out of the 1300 level as well, because now as bulls are trying to take control of the market here, they're definitely finding a lot of resistance coming in from all of the bar lows that are now sitting in the consolidation phase, and all of these mid-range horizontal support and resistance levels that can now come into play and create obstacle for buyers. So the market as it stands right now seems stuck between the support being provided by the 1300 level and the resistance coming in from this consolidation box that we saw form above the 1300 level. So unless we see the market sort of clear either of these two obstacles, we don't really see much activity for this market going into this week. Okay, so the next market we're going to be looking at here is the Euro currency futures market. This was another interesting market to follow last week. Finally, we have the market rebounding off an important former support area. So if you recall our analysis for this market in the prior weeks, we've been talking about this entire sell side momentum here building very strongly for this market. We've been notifying of all of these important levels here towards the left that we believed could play a role and provide some kind of support for the market and an obstacle for the sellers as price was basically pushing down. We didn't really see much support come in at either of these levels. We found a minor bounce off of this midterm support and resistance level, but nothing serious at all, and the market just continued to push down. Last week, when we were analyzing this market, we talked about how this strong bearish momentum could take price down to the 1.17 round number, and of course test this all-important swing low down here. And that's exactly what we witnessed for this market last week. The market sort of accelerated into the level. You can see we had a very strong, sharp-looking bearish candlestick here that closed strongly as well. And the next day, the market just rebounded just as sharply back up. And on Friday, we just saw the market sort of close just underneath the 1.17 level. So this to us creates a good foundation for the bulls to now basically be able to build some kind of momentum here. Although we understand that even now that the bulls try to regain control here, they might face some resistance coming in now from all these levels here. So even though we're considering all those possibilities, just looking at the strength of the bounce here and the importance of the 1.17 level, which we would like to retrade here. So if we zoom out of the chart, and look at the 1.17 level more holistically, we see that this is a very, very critical area for the market. Of course, we've had several occasions in the past when price found either formidable support or resistance at this level, and so the market sort of accelerating into the level and then rebounding sharply back above is to us a good indication that we could have a sustained bounce off of the 1.17 level here. So if you recall and rewind and look at the market action that we've had at this level in the past. So for example, both of these occasions, price found formidable resistance off the level. You can see that the market was accelerating into the level and then rebounding sharply off of it. So these are usually good indications that the bounce off of that support and resistance level will likely sustain itself more times than not. So going forward into this week, we're looking forward to some more bullish activity for this market. Okay, so finally we look at the 10-year Treasury note futures market, which for the most part last week was bullish. And again, no reason for us to be surprised why the market did what it did. In our last week's video, we talked about how this market, even though it's in a downtrend, or it was in a downtrend, we had all the indications that we needed to confirm that it was in a downtrend, which is that we had lower lows and higher lows, all confirming that the market was definitely bearish. But we had identified, looking at the more longer term picture here, that the price was pretty much very near an important area for this market, a historical level. In the past, we've had a major period of consolidation around these current price levels, after which we had the market basically rebounding for the longer term over here. This was back in 2011, and now that the market was obviously close to this price level once again, and this all-important historical support area, it is to be expected for the market to find some trouble. And even though we were in a very strong and dominant bearish trend here, there was a reason for us to believe that the market could do what it did. Even though it's really not something that happens all the time, horizontal support and resistance levels aren't always respected by the market, but usually these historical levels and these longer term support and resistance levels in round numbers tend to stop trends and create obstacles for price more times than not. So zooming back into the current action that we witnessed past week, we of course had pretty much most of the week where buyers were just dominant, and interestingly though, the market, even though the bulls were in control for the most part of the week, they were also able to pretty much press past the 120 major round number that we identified as a critical area in terms of the scope and the prospect of the downtrend continuing. So if we did find a lot of resistance at the 120 round number, we could have actually pushed right back down, and we may then would have had a possibility of the downtrend continuing on. But really, the bulls weren't able to find any kind of resistance here at all at the 120 round number, and we pushed straight through. Although we did later in the week find some resistance at the 121 price level at this former swing high over here. As you can see, the market really bounced pretty much to the tick off of this level, and basically for the end of the week, we closed sort of at the 120 round number. Of course, this is going to be a critical area now, and the first few trading sessions this week will be very important indicators of where this market is going for the more immediate to longer term. So if we do continue to hold at the 120 round number as support, the market could easily bounce right back up and possibly test the 121 region here once again to test it for formidable resistance. If on the other hand the 120 round number here does not hold, the market goes right back down, we could also be in contention for the downtrend to continue. So a lot really depends on what the market does as it opens on Monday, and of course as the week unfolds, and the 120 level either holds or does not hold as support for this market.